Have you ever looked at your investment statement, seen all the ups and downs, and just wondered, what's my actual growth rate? Well, you're not alone. The answer is hiding in plain sight, inside one of the most powerful and honestly simple tools in finance. Today, we're going to break it all down.
All right, let's get real for a second. Investing is a bumpy ride, right? Some years are great, others not so much. The path is almost never a perfect straight line up. So if you just average out those ups and downs, you're not really getting the true picture of your growth. So how do you find it?
So here's our game plan. First, we're going to nail down exactly what CAGR is. Then, we'll actually do the math together, step by step. After that, we'll uncover why a simple average return can be totally misleading. And finally, we'll show you how to add this to your own financial toolkit.
Okay, let's jump right in. What is CAGR? At its heart, it's the perfect answer to that whole bumpy ride problem. Think of it as the smoothed-out growth rate. It's designed to give you one single, clear number that represents the entire journey. Here's the best way to think about it. Imagine your investments journey is this wild, winding mountain road with huge peaks and deep valleys. CAGR basically bulldozes that road flat and turns it into one steady, consistent uphill ramp. It tells you what that constant, smooth growth rate would have had to be to get you from your starting point to your final destination. Now, you might hear compound annual growth rate and think the math is going to be a nightmare. But I promise you, it's way more straightforward than it sounds. We're going to do it together right now, and you'll see that anyone can figure this out. Okay, here's the formula. Don't let the brackets and exponents scare you off. The beautiful thing here is that you only need 3 little pieces of information to make this whole thing work: where you started, where you ended, and how long it took. That's it. So let's run through a quick example. Let's say you invested $10,000. That's your beginning value. And after 3 years, it's now worth $17,000. That's your ending value. And the number of years, our N, is 3. Easy enough, right? Now we just have to plug them in. So we just pop the numbers into the formula. We take our ending value, 17,000, and divide it by our starting value of 10,000. Then we take that result and raise it to the power of 1/3, because it was 3 years. And from that final number, we just subtract 1, and boom, there's our number, 19.35%. This is so powerful. It means that to get from 10 grand to 17 grand in 3 years, your investment performed as if it had grown by a perfectly steady 19.35% every single year. That's the true smoothed-out, compounded growth rate. Okay, now this is where CAGR really gets to flex its muscles. We're about to put it head-to-head with the metric you hear about all the time, the simple average return. And you're going to see why that number can sometimes be a complete illusion. This quote absolutely nails it. See, the average annual return, or AAR, is just simple math. You add up the returns for each year, divide by the number of years, and you're done. But it completely ignores the most powerful force in finance: compounding. Let's look at a new, more volatile example. You start with $100,000. Year 1, you're up a solid 20%. Awesome. But then year 2 hits, and you lose 10%. Ouch. Then you have a massive rebound and gain almost 30% in year 3. A total roller coaster, ending at $140,000. So, what was the return? Well, if we do the simple math for the average annual return, we just take 20, subtract 10, add 29.63, and divide it all by 3, we get 13.33%. And you know, that looks pretty good on paper. But hang on a second. Does that number really tell the true story of how your money grew? Does it capture what actually happened to your portfolio? Let's run it through our CAGR formula and see what the reality is.
And there it is. The real compounded annual growth rate was actually 11.87%. That is a huge difference. The simple average made it look better than it was because it ignored a critical detail. That 10% loss in year 2 was a loss on a bigger pile of money, which puts a much heavier drag on your actual long-term growth. So here's the bottom line. The average annual return, AAR, gives you a quick but sometimes very misleading picture. It can easily overstate your growth when things are volatile. CAGR, on the other hand, shows you the stone-cold reality. It accounts for compounding and gives you the true, smoothed-out growth rate over the long haul.
So, we know what it is, and we know why it's better. But now, let's get practical. When should you use each of these metrics? How does this fit into your financial toolkit?
Think of it this way. AAR is fine for a quick year-by-year glance. It's a short-term snapshot. But when you're playing the long game, When you want to measure your actual strategic performance, or you want to compare two different investments side by side, CAGR is the tool you have to use. It's the one that understands the true power of compounding.
If you take away just one thing today, please let it be this. Those ups and downs, that volatility, isn't just noise. It has a real mathematical impact on how your money grows. And CAGR is the honest broker. It's the tool that accurately measures that impact and gives you the real story. So the next time you see a mutual fund bragging about its average annual return, you'll know to dig a little deeper, won't you? You'll know to ask for the real number, the CAGR. It makes you wonder, what other average numbers out there aren't telling you the whole story?